Well, if you're an avid watcher of Bloomberg News, you might have noticed that we have been harnessing the power of the Bloomberg terminal to really find the best of the best, from fund managers to economists to currency strategists. Ted Kellner was one of the names that topped our data. As chairman and CEO of Fiduciary Management, he helps run the FMI Large Cap Fund, which ranks in the 98th percentile over the past 5 years. And he joins us on this Monday from Milwaukee, Wisconsin. Ted, good morning.
Good morning, Carol. How are you?
I'm doing well. The market doing well from those March lows. We've seen quite a bounce. What do you think? Where do we go from here? More room to run higher?
Carol, we're a little more cautious right now. We've had, as you mentioned, a 40% move off the bottom, the bottom from early part of March. And if you look at stocks right now, a lot of the gains reflect what we think is a better environment, but the valuations have gotten a little richer, so we're a little bit more cautious right now, frankly.
Right, and you really see that in the valuations, correct? Because back in March, everybody's saying there were some great plays out there. That rank has thinned at this point.
It has thinned, and right now we think that investors may be disappointed with the earnings that come down the pike in the next few months as this economy, while I think we've close to hitting the bottom, the rebound we just don't think is going to be as great as investors think right now.
And that's something you got to keep in mind when you're taking a look, because, yep, maybe things are not going to get worse, but it's going to take some time for it to get significantly stronger and much better, right?
That's correct. If you look at this, is a financial, really a financial over-leveraging of major proportions at this juncture. You look historically, those kinds of recoveries tend to be slow and not real sharp recoveries. They tend to be more protracted and longer in terms of coming out of the bottom of the market.
Ted, you've got a great 5-year track record. You're pretty much beating all of your peers. What's your strategy, and particularly in this environment? It's a tough one.
It is a tough one, and while we took put a few stocks in our portfolio to reflect what we thought would be a better environment, right now we have stocks. We think I heard you mention Walmart, which is one of our large positions. We have what I would describe as stocks right now, a portfolio of companies that are positioned for maybe a little slower type of recovery.
Well, talk to me about Walmart, because you do like it. It's one of your top 10 holdings. It's down 11% for this year. It's up about 7% from February low. So it's not had the bounce that we've seen from some of the other retailers, but I guess not so bad considering that Walmart was up last year while many weren't.
That's true. It was one of the better stocks, performing stocks on the New York Stock Exchange, as you know, last year. But when we look at our time horizon is 3 to 4 years, Carol, and we look at the valuations of a company like Walmart, there we think doing everything right. We're a return on invested capital metrics focused company. Walmart has done a terrific job of improving profitability in almost every year for the last 10, 15, 20 years. Yet the valuation is at a 10 to 15 year low. The stock sells at about 14 and a half times forward 12 months earnings in a range of about 13 to 50 times over the last 10, 15 years. So you look at the company doing what we think is an excellent job, and the valuation at almost historic lows. We like what the company's doing.
So, Ted, do you feel relatively optimistic about the strength of the U.S. consumer then?
Well, not really. The consumer's over-leveraged, and that's why we like a Walmart, frankly. I mean, Walmart really delivers terrific value to consumer. In fact, one of the issues one of the real strong points of Walmart right now is they're garnering customers with higher incomes as they're trading down, and we hope that they'll keep those customers. But we think the consumer's in pretty difficult shape. But Walmart is serving those consumers in a tremendous fashion, and they're gaining market share at almost all income levels.
Hey, let me ask you, though, Ted, because you know what everybody thinks about when they come to Walmart. Okay, it makes sense in this tough economy that people are shopping at Walmart. They're trying to save money. Will they hold on to those customers, though, when the economy starts to improve, in your view?
Well, that's a key question and a key issue because, as I just said, that they're gaining market share in the $50,000 to $150,000 income level. But we think that the merchandising strategy, which was an issue for Walmart in the last couple of years, we think that the merchandising strategy is gearing up to try to retain those customers as the economy turns. And right now, as we look at it, the analytical team at Fiduciary Management looks at what they're doing. We think they're doing it and have a very good chance of retaining, maybe not all, but a large share of those customers when the recovery in the economy recovers next year.
Ted, just got 30 seconds left here. Dentsply is another name, not a household name that you like. Quickly, why you like it and why you think it's going to continue to move higher?
Dominant company in the dental industry at the high end in a tough market, as you mentioned, tough economy. Some of the more profitable product line is suffering a little bit. A lot of consumables. They are dominating their market both here and internationally, and we think that they're going to continue to gain market share. Again, stock selling at about a 10-year low valuation-wise, so we like that stock a lot as well.
Got it, Ted. Great to get some time with you. You have a good week. Thank you. Ted Kellner, everybody.